Welcome to the Jay and Brian Show, the fastest growing real estate finance podcast in America. Today's show is brought to you by My City Lender. Here now, Jay and Brian. So Brian, it seems like there's a lot of fear in the marketplace right now. And is this validated right now?
That is an outstanding question, Jay.
Should people be backing out? And, a lot of people that were on the fence, should they stay on the fence or just get off the fence?
Should investors not be buying rental properties right now or selling their rental properties?
I don't know. I still think it's a really good time to buy.
A lot of questions going on right now. There's a lot of anxiety, people worried about the economy. Are we in a recession? Are we not in a recession? Depending on who you talk to. Rates are on the rise. That seems to be, I think, the biggest point that people are looking at right now are the higher rates. I mean, yes, we're near 20-year highs, but when you still look at it in a historical context, we're not in the double digits the way we were in the 80s. Affordability, that's another question on everybody's mind. What do you make of it? I mean, what do you think? I mean, people are asking us, the question that we get the most right now is should I wait? Should our value's going to come down? Will I get a better value if I wait a couple of months? Will rates come back down? What do you do?
I don't know. It seems like there's a lot of different ways to do this. I don't necessarily think that this is the time to just stop buying. I think that the real estate market here in Phoenix is going to continue to do well because there's still so many people that are moving here. Mm-hmm. I don't see that the market changing here all that dramatically, though I know that we're in what would be called a correction at this point. It's probably going to stay that way for a little while longer, but I don't see it happening, for a really, really long time.
It's really it depends question, right? It depends. And we don't have the crystal ball. Everybody has a unique situation. Some people are thinking about buying a primary home, maybe second home or investment property, but the answer is it depends. What are your goals? Long-term goals, short-term goals. If you're buying a primary home, for example, one of the results that we're seeing with rates going up and obviously affordability is a challenge right now, but inventories are rising. Homes are taking longer to sell. So there's more homes to look at. So
way more options.
So if you're a family that's been trying to upgrade and maybe upsize because your family's growing, you have a lot more homes. Well, either direction, even if you're retiring. I mean, there's just way more homes to look at. My parents are a great example. They've been looking at buying homes for a year or two now. And just a year or two ago, there was very little to look at. And when something came up, they had to hop on it. They were competing. There was 30 other people, in line for the house. It was crazy.
It was insane.
And now fast forward to today, yes, home values are quite a bit higher than they were a year or two ago, and rates are higher. But now they've got a lot more homes to look at. When they go out to look at a house, they can take their time and decide if it is the right house, formulate a plan for how they want to offer on the house, and that sort of negotiate. You're not having to give up you're not having to waive an inspection or an appraisal,
right, yeah.
Put your earnest money, at risk if things don't work out in that regard. I mean,
the terms seem to be more favorable now to the buyers than it's been in 2.5 years. So, and we're starting to see some really unique programs come back online. Right. For example, I haven't seen this for about 15 years now, but the buy-down
programs, yep.
Where you can actually buy the rate down using a seller concession. Mm-hmm. And so, for example, the way this would work is if, let's say the market rate, was about 6.5%, you could actually buy the rate down for the first 2 years. So 4.5% for the first year, 5.5% for the second year, and then 6.5% for year 3 and beyond.
And to clarify, it's the seller that actually pays for that buy down. And so we were in a buyer's market again where buyers can negotiate a seller credit. Sellers are motivated to offer a little bit of extra value to be able to sell their house. And so that's where the buy down program comes in. The seller pays for that buy down, and they are effectively subsidizing the interest rate in that entirety. So
it's really a tremendous benefit
the first year or two, depending on which program you look at. So that's bona fide savings for buyers on top of being able to look at a lot more homes before making a decision. Absolutely. Sure. A lot of people are looking at that program and they're wondering, is it like a gimmick? I mean, we hear that because we haven't seen it in so long.
Exactly. Yeah.
Yes,
Yeah, really.
lenders are definitely looking for ways to sell more loans. Obviously, the investors out there are looking for more ways to do that, and this is one way that they've come up with that does allow the seller to subsidize the interest rate for a brief period of time for the consumers. It's one additional way, a very powerful way potentially, to you take advantage of a seller credit. I mean, you can also look at buying the rate down on a permanent basis if you think you're going to live in the home a long time.
Yeah, it just seems like it's got less impact, especially on the front end.
For sure, for sure. The buy down programs have a huge impact right up front.
But I think it also helps to kind of divert some of that fear as far as the rates go. And,
Yes.
Can I afford this, or can I afford this payment? And it really helps to kind of divert some of that fear.
And people are asking us all the time, will I be able to refinance, a year or two down the line? And the answer, generally speaking, is theoretically is yes.
Yeah.
Nobody has a crystal ball. We don't know what rates are going to do specifically, but if rates do fall and it is viable, absolutely, you can look at refinancing down the line. And a year or two from now, with the buy down program, for example, if you do that, the higher interest rate is really well mitigated.
And if the rates go up, I mean, that's the other side that I don't think people are really starting to think about either. It's
a possibility.
If the rate goes beyond what the 3+ year cap is on that, it's the fully indexed interest rate, or the actual full note rate, which is how the loan is qualified. But if the interest rates go beyond that rate, the 3-year rate, they're still locked in at the original note rate. So either way, I feel like they've got,
there's payment really protection there in a way,
yeah.
right? Because if rates go up, your payment is going to stay.
Yeah, if the rates go into the 8s or higher, it's the rate is still locked in at what it was locked in on the 2-1 buy down. So either way, I feel like it's majorly beneficial for the buyer.
So where do we think rates are going from here? Because that's obviously the question we get at this point is, should we wait? Are rates going to come down? There's just, there's so much conversation, coming out of the federal government, and especially the Fed. The chairman of the Fed right now, really the whole board is trying to attack inflation as they really need to be, because the cost of living, cost of everything it just kept spiraling up and up, and so they're having to curtail that. They do have a view that home values are high, that affordability is at lows that we haven't seen in quite some time, and
by increasing the interest rates, it's actually going to force the purchase prices down.
Right. That's going to be exactly one of the main pressures that causes home values to come back down,
and they've acknowledged that this is going to be a painful thing
for a little while to come. 6 months, a year. It's hard to really say. What happens after the upcoming midterms. Nobody really knows where we go from there. But I think one thing we should definitely talk about is the variety of lending options that are now available to consumers out there who are looking to purchase a home, whether they're a primary home W-2 buyer or an investment property, an investor looking to buy a short-term rental. There are a lot more options now with independent mortgage brokers like ourselves, as opposed to the big banks or the large retail companies out there that tend to have smaller lending boxes. With brokers that are on the rise right now, there's a lot more opportunities for people to get the financing to get the right home right now.
Absolutely. Yeah.
I mean, just take the investment property programs that are out there, like for vacation rentals, for example.
Yeah.
The DSCR, the debt service coverage ratio loans that allow investors with no limitations on how many investment properties they own. This is just an example of a great program out there to qualify to purchase that home based on the rental income for that property only. Does the rental income cover the entire housing expense and then some? That's it. There's no additional income. There's no tax
returns, none of it.
Yeah.
Which is great. A lot of it seems like a lot of the people that are in this, in this segment, I guess, of buyer, a lot of them are self-employed. Mm-hmm. And so getting through some of the red tape with tax returns and really not having to provide any of that information, it just makes the process that much easier.
Yeah, absolutely.
And HELOCs, I mean, that's another product that just it came again out of nowhere. For a long time, there really was not a lot of HELOC product even in the market. And now all of a sudden it's just come back with a vengeance, and we've got options with HELOCs and even fixed seconds.
Right. I mean, it has been for a long time that you were limited to, again, banks and credit unions and larger institutions like that, where you could get these seconds, these home equity line of credits or fixed seconds.
If you could tolerate it, if you could tolerate the process, it was rough.
I mean, it's really no different. It's really not much different than a traditional mortgage process these days. I mean, it's generally the same paperwork, the same type of qualification. I think the appraisal process can be a little different. I think a lot of those the second appraisals are not as detailed.
Right. Yeah. You're going to see more drive-bys and automated value type programs.
And as primary interest rates rise, the seconds become a whole lot more attractive because it's an opportunity to still get at your equity. If you have goals with the equity in your home, whether it's paying off debt, paying for kids' college, you want to remodel, you've been thinking about doing that a long time, you can still actually get at your equity with a fixed second or a HELOC.
Somebody called yesterday
without having to refinance your loan.
They got to put a roof on the house.
Yeah.
And so they called about a HELOC yesterday. Yep. So yeah, it's a great way to kind of access that. And again, if rates come back in line for the first mortgages again, it's something that can always be consolidated. Line of credit gets paid off, and the variable feature of that loan ends with the refi. So it's just another great way to kind of access equity today and not really have to do much trying to access the first mortgage. Or you just let's say you have the 2.5% first mortgage rate that you got in 2020, and you don't want to touch that rate.
Understandably.
The HELOC is a great way to just access the equity temporarily and get what you need, use what you need, and move on.
Yep.
But
so we spent a lot of time talking about the market in terms of for our borrowers, like what from our perspective, what should our borrowers be thinking? But how about the agents that we work with, the real estate agents? I mean, we talk to. We're constantly in contact with our agents, and we're, depending on how you talk to, it's pretty tough out there. There's inventory is still relatively low, even though it's coming up. It seems like a lot of them are nervous about the market. I mean, what's our messaging to real estate agents out there?
Hang in there. Just be patient. Yeah. It's going to take time, and this is not going to last forever. It's if you can endure the time, it's going to be. It could be tough for a little while longer. I'm hoping that by the time we get into the spring months of 2023, things are going to look different than they look right now. I have a feeling, I don't know again because I don't have the crystal ball, but I have a feeling that we're going to start to see tapering on the interest rates and all of the kind of the inflation prevention measures that they're trying to implement now. I think a lot of that is going to be kind of in effect by then. And so I'm hoping that by the spring months of next year, we're going to start to see things opening back up again.
It is interesting because what we're going through right now economically is different than, what happened in 2008, 2009. A lot of people like to compare, especially in our industry,
because it feels a lot like it.
It feels a lot like
it, but I don't think it's got the same ingredients that the crash that we saw, let's say between 2008 and 2010, even in this market, it doesn't have the same ingredients.
Well, it's very different, right? Because back then you had this major credit bubble in the housing market. You had all kinds of loans being done that were not creditworthy loans, right? They were stated income loans. There were all of these subprime loans that really aren't much of a thing at all today. And so the housing debt that's out there right now is relatively safe because everybody's had to fully qualify for it. You can't state your income and get a loan. And so there isn't this major credit bubble that's overhanging the thing. I mean, you do have broader economic forces with affordability and inflation, recession pressures that I think are definitely going to have a real impact.
Another issue though is that we've also seen now the government stop buying these bonds,
right?
Mortgage-backed
securities. Well, that's what kept the rates so low for so long, is they were purchasing billions of dollars worth of mortgage-backed securities, putting cash into the market, which is what was helping
it kind of
keep the rates down.
They were almost artificially low.
Yep.
And so, really to have more of a healthy balance on that, the interest rates really need to be somewhere in the fives, to have a stable, healthy, the mortgage-backed securities and have them have a stable, healthy price.
So does that mean that the Fed needs to come back in and start buying up mortgage-backed securities?
They may need to.
Because they didn't just stop buying mortgage-backed securities. They actually have been trying to sell off their balance sheet sell off all of these mortgage-backed securities. So it's kind of like a 180 that they've done. So they need to come back to some sort of equilibrium, right? Yep. Where it's kind of equal and
but
equal
for
out.
it to be healthy, that's where we kind of need to be.
But they're having to react so harshly.
And I think
inflation.
It's palatable. That's the problem is when everybody was used to seeing, interest rates in the 2s and the 3s for so long.
Yeah.
And then all of a sudden now we're in the 5s and then it jumps into the 6s and we saw them bump up to 7% and in a really short period of time.
It's amazing how it changes your perspective. I mean, in January, my mother-in-law bought a house up here to move up close to my wife and I, and I was like, and I'm in mortgage, right? So I'm helping her with her loan, and we locked in her rate.
You're all sensitive on her behalf.
We locked in a rate at 3.5%, and I remember thinking at the time, oh my gosh, we missed it was a few months ago, we could have been in like 3 1/8. Oh my gosh, like this is terrible that we're locking in at 3.5, but it's okay. We could refinance at some point if the rates come back down. And now 3.5 looks really good.
It sure does. It sure does.
I think that there's reason to be cautious, but I think that there's a lot of good reasons if you're buying a primary home, for example. There's just a lot of good homes to look at this point, to take your time to find the right fit. And I think that's just as important as, and maybe more important than what your initial interest rate is. I mean, I look at my personal, home ownership journey, and when we bought our first house, I think our rate was 6.25 was our first rate. And within a year or two, we were able to refinance down to the mid 4s.
Ours was 7.
7. Okay.
And we had a second, and the second was 12.5. So it's all relative.
Yeah.
I need to go back in time and see all that. But we were excited. It was our first home, and we were excited to buy it.
If you have an affordability conversation about it before you look at or focus on what exactly is the rate, and you decide, yes, we can afford this. We can afford this monthly housing expense and still accomplish all of our other financial goals, regardless of what the interest rate is. I think that should, again,
we
if
were
you're
paying
primary
rents,
home, that should drive your decision more than what the specific interest rate is at the time.
Well, especially I think if you're a first-time home buyer and you're comparing, okay, so this is what I was paying in rent to this is what I would be paying if I, were to purchase my own place, and this is now my mortgage payment. And how does that compare? And I think that ratio, when you start comparing that really is more important even than what the rate is, because the rate of renting is 100%. Have you seen that?
Yeah.
Your rate when you rent is 100%.
Yeah.
Because you're absolutely building zero equity in the property, and it's 100% liability. So,
yeah, I mean, we're a perfect example of that. When we bought our first house in 2002, we were paying a little less than $1,000 a month in rent, nice Mark Taylor property, and bought our first house for $177,000, which sounds great now. But our payment went up from $980 to like $1,500 a month on a 6.2% interest rate. And I remember at the time thinking, oh my gosh,
I don't know how we're going to afford this.
This is so expensive. But here we are 20 years later, and the amount of wealth we've accumulated by trading up twice. In the 20 years we've moved twice since then, has been wonderful. And it's definitely has us set up. We're in our mid-late 40s now. It has us well set up for the future. So was it worth it? 100%. It was 100% worth it. I mean, there's a huge stability factor in owning your own home. Yes, you have to take care of all the little things that come up, but having that foundation where you're not worried about your rent going up, you don't, things can happen. People can lose jobs. I mean, there's any number of things that can come up that can throw you a curveball and have you having to move or figure out a different living situation, of course, but generally speaking, I mean, as a homeowner, you just have this foundation that you can build your life around, and your family and your career and everything else, and just have that stability where you know that payment is going to be that payment. And yes, if rates go down, we can refinance, and yes, along the way we can maybe look at using equity to pay for some other financial goals, or make the house more our own, which is really a neat way to go. But when you're renting, there's a lot of variables that you have no control over.
Yep. So I would say, if you know this is where you want to be, and you're ready to commit at that level, it's great. It's really great. But it's I actually heard yesterday, I got another call, which I thought was really interesting because it came from somebody else that was looking at another new build community out in Eastmark in Mesa. And they actually mentioned to me that the new home sales consultant that they had been working with just let them know that they were so busy. This is a new build community. Okay. Like Mesa, it's hot. It's Eastmark.
Right.
And that they were so busy, they were selling like 50 homes per week.
Wow.
At one point. Earlier this year.
Per week.
Wow. Earlier this year. And then that dropped to about 20. And then it dropped to about 12. And then they're at about 2.
Wow. Per week.
So if that's any indicator as far as, looking at what's available today versus what, and I know new builds are completely different than resale homes, but if you're going to compare, if you're out looking to buy a home, whether you're looking to buy a brand new build or you're looking to buy a resale home, if that's any indicator as far as what you can get for your money now, that the price corrections are coming for the new builds.
Yep.
Because the new builds tend to run higher than what you would pay per square foot on a resale home. So if you start looking at, hey, maybe we should go buy a new home, or maybe we should start looking at resale homes, the value that you're going to get on a resale home today versus what it was 2-3 years ago, it's going to be amazing today in comparison. Plus, we're talking about, the potential of a seller concession. It's 100% funded by the seller to potentially temporarily buy the rate down. Which gives you kind of an abated payment, in a way, because it's at least,
it's a subsidized payment, basically.
It's a subsidized payment. So, in order to have this,
and you still qualify at the full rate, just to be clear, but the seller is effectively paying a portion of your payment for the first couple of years.
But you put these things together, and it really is it's a beneficial time if you're a buyer looking to buy and you've been on the fence.
Well, and it's more than just that. I mean, it's you're not going to be faced with having to waive the appraisal contingency or waive the inspection contingency. Everybody should get an inspection when they buy a home and be able to know what they're buying and potentially be able to get things fixed before they actually close on the house and move into it. So, I mean, all these things add up to, I think, a very favorable market if you are a buyer.
I agree.
Yep. And investors, I think there's still opportunities, even if you're not buying a primary home, but you're thinking of investing for like
that's another thing.
rental property.
So on the investment side, I think it's still a good time for people to buy because if you're in that market and you're looking to purchase a non-owner occupied investment type property, even a second home. Now the competition isn't what it was, where you've got all these institutional buyers,
right?
iBuyers, and a lot of these companies have stopped buying homes.
Slowed way down. Yep.
Yeah, or just stopped completely. So now, as an investor or second home buyer here in this market, you're not competing with all of these institutional buyers or institutional investors trying to just gobble up all these properties.
So you're able to get a house at a value, and the rental market's still strong. So you're able to, and plenty of renters out there that are challenged by the affordability of purchasing a home, so that the investment's going to pay off for you because you're going to be able to rent that and do pretty well with it.
So all in all, I still think it's a good time. I think it's a great time. So
yeah, well, good conversation, good stuff.
For sure.
It's obviously a turbulent time in our industry and in the housing market, and being in the Phoenix area, the swings tend to be a little bit larger than other parts,
more dramatic
than other parts of the country, but it's still a large great housing market, a lot of opportunities, and we look forward to working with families and investors alike to help them realize their home ownership goals and their financial goals, and just to be there for you as a mortgage company.
For sure.
Well, thanks for watching, everybody. We will stay tuned, and we'll see you guys again on the next episode of the Jay and Brian Show.